We know this is a tough environment for most retailers. We've seen that over and over again this earnings season. According to conventional wisdom, the department stores should be getting hit the hardest. But something surprising happened on Tuesday when Macy's reported a tremendous beat and raise quarter. That sent the stock up 5% in a single day. More important than the quarter, Macy's management told a great turnaround story. Remember, this was the company's first full quarter under the leadership of Tony Spring, who took over as CEO in early February and was appointed chairman in April. Before the promotion, he ran the incredibly successful Bloomingdale's division. This was also the first quarter after Macy's reached a détente with Ark House Management. That's an activist fund that teamed up with some other firms to launch what I can only describe as a combination takeover bid / proxy fight with Macy's board. It was all very confusing. Ark House did get 2 board seats in April, but it's a really big board, though. And the group still wants to buy the company. I mean, their last bid was $24 per share in March, although the company has cast doubt on their ability to get financing at that level. It's all very strange. Still, with all of that going on, this felt like a make-or-break quarter for the new management team, and they definitely made it. Macy's company-wide comparable store sales declined by 1.2%. Wall Street was looking for down 3.1%. When you look at only Bloomingdale's comparable stores, their sales were up 0.8%. Bluemercury, that's their cosmetic business, that was up a strong 4.3%. Overall, total revenue came in a bit better than expected, and lower selling, general, and administrative expenses more than offset a slightly weaker than expected gross margin, what they made after subtracting the cost of goods sold. That translated into an impressive earnings beat of 27 cents per share. Analysts were only expecting 17 cents. That's why the stock really popped. On top of that, Macy's gave you very encouraging guidance for the current quarter and slightly raised its full-year forecast on nearly every line. All right, so how the heck are they pulling this off? When you read through the conference call transcript, there were a couple of key highlights. First, Macy's plans to rationalize its store count, then invest in refreshing locations that it tends to keep open. At the end of last year, the company had 718 stores, including 502 Macy's banner locations. But as part of Tony Spring's turnaround strategy announced in February, they're going to close, that's right, close 150 of the worst-performing Macy's stores by 2026, including 50 this year, which will allow them to focus their investments on the ones that remain. You don't throw good money after bad in the retail business. You put it where the good is. I think it's a smart plan. I think it's a bold move to cut bait on stores that just weren't working and really didn't have a hard... I don't know how you would ever turn them around. Now, as part of the rationalization effort, Macy's said it would start by updating 50 of the good stores. You know what they call it? The First 50 program. It's basically a pilot program. They want to figure out what works and what doesn't, and then apply those lessons to the other 300 locations that they plan to update. On Tuesday, we got our first report card on this First 50 program, and boy, I got to tell you, it's all A's. While the overall Macy's banner saw comparable store sales down 1.6% down, those 50 stores being updated had comparable sales of up 3.3%. That's a very big delta. On the conference call, Tony Spring explained exactly what they're doing at these 50 that are really working. Enhanced merchandising, rollouts of more elevated products, new marketing pilots, not to mention engaging live events and additional services like personal styling sessions, fashion shows, beauty services, all of which boosted traffic and sales. It's working. Net promoter scores, NPS, for the first 50 locations improved dramatically. Overall, it's a very encouraging start for the Macy's turnaround. I like that. The second pillar of the new strategy is to, and I quote, accelerate luxury. Meaning management wants to improve luxury sales at Macy's locations, especially the First 50 program stores, and grow the company's other 2 banners, the upscale Bloomingdale's and Bluemercury, which is their high-end cosmetics and skincare concept. In terms of luxury sales, Spring said that customers were responding well to higher-end brands that Macy's either introduced for the first time or gave expanded distribution to, and there were a lot of new ones. When I looked them over, I was really surprised. As for Bloomingdale's and Bluemercury, they are doing very well. Spring said that, and I quote, the power of Bloomingdale's position in the upscale market is its diversification across categories and price points, allowing it to gain wallet share even as there are shifts in popular brands and categories, end quote. Bluemercury, meanwhile, had its 13th straight quarter of same-store sales growth, driven by continued strength in skincare and expanded distribution for popular beauty brands. Unlike the core Macy's brand, where management is eager to shrink the store count, they're actively looking to grow both Bloomingdale's and Bluemercury, but not in any sort of runaway fashion, which is good. Why shouldn't they put more on? The numbers are that great. Put it all together, and I believe Tony Spring can deliver on plans, especially when it comes to making the Macy's banner more upscale. Remember, this is the guy who previously ran Bloomingdale's, their upscale department store, which has been very successful for a long time, even when the rest of the business struggled. The flagship Bloomingdale's on the Upper East Side is so popular that there's often a line to get into the joint. Tony's now unleashed his luxury expertise on the entire company. I think it's a smart move, especially at this particular moment, when the consumer's weakness is mostly isolated to lower-end shoppers. You don't want to be in the business of cheap apparel right now, not when you have to deal with ultra-cheap competition from Asian discounters like Temu and Shein. There's a third aspect to Tony Spring's turnaround plan. He wants to simplify and modernize the company's end-to-end operations, basically back office cost savings. I thought they had already done this. I don't know. Macy's digital operation is under new leadership, but there's progress being made there, too. This quarter, we saw they're doing a great job of cutting costs. Several analysts called out the expense control as highlight of the quarter, even as it really isn't all that sexy. Listen, it's early days for the Macy's turnaround. Tony Spring's plan was only announced 3 months ago, for heaven's sake. It's going to unfold gradually over the next 3 years. I'm sure there'll be highs and lows along the way. But this week, we heard about a lot of progress in the initial few months of that effort. And I got to tell you, I'm feeling really good about Macy's. I mean, really good at this price. By the way, don't forget about that ARC House takeover attempt, which is still ongoing, even if it's somehow kind of on ice for now. I never recommend a stock solely based on takeovers. That's a fool's game. But it doesn't hurt them to have waiting wings if something doesn't go right. Bottom line, I see multiple ways to win with Macy's. Either Tony Spring keeps pulling off his ambitious turnaround, and I believe he can do it, or someone else comes in and buys the darn thing. Remember, ARC House and its compadres offered $24 per share, which is up almost 20% from where the stock's currently trading. Nobody believes that Macy's will sell. They shouldn't. But the fact that the option may be on the table gives you a nice fallback if the turn falters. Let's go to Philip in Alabama. Philip.
Oh, hey, Jim, this is Elizabeth, Philip's mom. We're on vacation in Lake Martin, Alabama, but Philip is, of course, thinking about his stock profile. So here's Philip.
Philip, how are you?
Good. How about you?
I'm doing fine. Thank you for asking. What's shaking?
Well, the other day at school, I got in trouble for looking at stocks, but my research led me to the Cheesecake Factory before I got kicked off my computer. I like the almost 3% dividend and current revenue growth. However, my dad is fearful of restaurant stocks. Do you think I should invest into this stock or go outside and play?
Holy cow. First, we're going to discipline that teacher, who obviously doesn't have a clue about where you're going in life, because I can tell you you're going far. Cheesecake Factory has just come back down a little bit. Sells 11 times earnings. Got that great yield, as you pointed out. It always surprises me to the upside. I think you should own it. I think it makes a lot of sense. And I got to tell you, I'm going to pay you my highest compliment, Philip. You got horse sense. Let's go to Lori in Illinois. Lori.
Hello there, Jim. I'm just wondering about Chipotle. Do you think that it is going to do that 50 to 1 split? And do you think it's still a good buy as of right now?
I think it's a great buy. The split is going to bring in more people. By the way, the main reason they want to do the split, just to be really clear, is they want to be able to compensate employees with actual stock and not just like a quarter of a share, which is really smart. The guys who run this company, I'm talking about Brian Nickel, Jack Harton, they are about as smart as I've ever seen, and I think it is a buy right here. No, a strong buy. You got a winner. Let's go to Joel in Florida. Joel.
Jim, good afternoon. First thing I want to say is I'm a member of the Investing Club, and it's the best money I've ever spent.
Yes.
I've been listening to you for 19 years, and I've learned one thing. You're not a financial advisor. You're a financial educator.
That is so right.
That I have and what I can pick up from you and other sources, you've changed my entire life.
I am writing this down.
Leave it at that.
I can't thank you enough. I had an existential crisis going into this weekend because I'm saying, listen, I want to garden so badly today, and then I am so glad I did not take the day off because I would not have gotten your call. So I completely am so thrilled that you called, Joel. How can I help?
Understand. You know, some of the things in my investing, I hate to sell certain stocks, and I hang on to them. Well, I've hung on to Adobe for almost 20 years. And it's been quite a ride for the last 20 years. Recently, you don't hear too many people talking about Adobe.
Well,
all the other AI things and so on. And yes, it's come off quite a bit, but, you know, it's still a great company. And I'm just wondering how you visualize Adobe along with all the other
Okay, I think there is a crisis. You know, to me, there's a difficulty at Adobe. I mean, let's take Mike Parsons' daughter, the designer. I mean, she switched to she has the full suite. She couldn't afford the full suite. I bought it for her. She was using Canva, which is not as good as Adobe, but the Adobe suite costs a lot of money. And I think that's what Adobe has to wrestle with. It has got a very expensive, but by far the best product. That said, Shantanu Narayan's going to figure it out. I bank with Shantanu. I think he's just very strong, and I really appreciate your comments. And I meant it about, I'm so glad I didn't take the day off, because you just made my weekend. All right, I see multiple ways to win by holding on to Macy's here, either through their ambitious turnaround efforts, or, and I hope not, because I want Tony to have the run of the joint, a potential buyer. Now, mad money, lots ahead. We're going to play Am I Diversified, see if the portfolios of Cramer are positioned for success. It still matters to me as much as ever. Plus, where do we stand on the road ahead to lower rates? I'm I'm revealing some signs to keep an eye on. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.